Welcome to How to Read an MBI Chart Part 2, the basics. And we started off looking at just a regular chart with some of what you had to learn were the regular indicators that most people commonly use. And I briefly showed some of the deficiencies with those. Not to say that they aren't effective at some points, they are. But just on a consistency basis and one that will yield the highest return, we found a better way to go. And when we started to add in from the simple green trend of our trend model, going from red then to green, gave us a clear idea of whether trend was moving higher or versus moving lower to sideways. We then add in several of our other indicators, our shakeout, up, down, and our expanded ratio histogram. Now, they look very foreign, but when we break them out into simpler terms, a little bit of the mystery of them will fade away in the next couple of minutes, and these charts will become rather clear as far as what is happening in the market. Commonly, people look for overbought and oversold, and within that, our shakeout indicator is very effective in determining that. The white histogram as it rises is giving us an indication, as long as it's above zero, that we are in green trend and moving higher. However, when we get a lower histogram reading, it indicates to us that we're about to have some type of a correction. We can then utilize our ratio histogram and where we are in the shakeout indicator in relation to our two other lines, the yellow and the red here. In a little bit more of the advanced studies, we can get into exactly what that is, but you can go through here and point out each of the times where the histogram dips lower, and you can then see the correction in the market. Now, what are the yellow and purple lines? Well, the yellow line is our warning line, because unlike your regular oscillators that get overbought after sometimes very quick moves or single large moves, we don't get overbought until we're starting to reach this yellow line, and then we really aren't overbought until we've reached this purple 25 line. And as you can see here at the peak in mid-September of 2012, that's when the market actually became overbought. And it wasn't until then that it was overbought, whereas most oscillators at this point were well into their high-end period, and then they just move across because they're not able to reset as ours do within specific time frames of the market. And that's sort of kind of the fractal separation between what these indicators are doing compared to just a general oscillator type indicator that uses moving averages, and so those averages stay in a certain range. We're not using any moving averages with these setups. Our up-down power allows us to break out both buyers as well as sellers, and what we look for is the relationship between the two. And when we reach a situation, particularly in a up move where we've become overbought and we see a large number of sellers in relation to the buyers, typically over 70%, and that's very easy to get that ratio, it lets us know that that's a good opportunity to short the market and or at least to exit our long positions and wait for some type of a correction, knowing that we're going to have some degree of a move lower. We can also use divergences within these setups, because this is where we were pointing out here as we were approaching what some people were referring to as a double top. But even before it reached a double top, when we were buying down here, we knew it was going to be short-lived because our histogram was so much lower than the previous high. And when it ceased to make additional highs, we were already out. And the most recent one, we were big buyers of these fractal buy setups right here, but we were exiting because the indication from our ratio histogram was telling us to exit that maneuver, and we also had a couple of other fractal sell signals that appeared right at the peak. We actually took out at the day before significant decline took place. Now, when it comes to the ratio histogram, as I refer to it, and this happens to be an expanded version, the reason it's expanded, we add the little orange line, and the orange line gives us a bigger clue as to how strong a trend is in relation to a move. And as long as the orange line stays above the blue line, or cyan as I refer to it, your uptrend is intact, and most likely any corrections are going to be short-lived. It's when we move below it and stay below it that you end up with red trend. But I often tell people to refer to this as a highway, where the red line is the center median of your regular street, and your one lane going one direction is up to the purple, and the lane going the other direction is at the green. And as long as you stay within that highway, everything's fine. It's when you start to get to the shoulders, which are the white lines, and then going beyond the shoulder, which means you're off the highway, you really start to get the exaggerated moves. And these are the areas where we take advantage of serious bifractal opportunities, because the algorithms, in order to get these kind of deviations, are pretty extreme. And as you can see, in a normal rising trend, pretty much stays even, and then you get these extreme outliers, which belie very serious changes in perception for the market and what is about to happen. And in particular, coming down in this particular point when we were in a downtrend, we saw the good opportunity to buy, but we also knew it was going to be very short-lived, and in fact it was exactly that. And that is because we were able to get into a little bit more deeper concept of what overbought, oversold really is within the market. And then lastly, you'll find us with this extreme histogram popping up, and this extreme histogram just kind of makes that chart seem so hectic. And unless you really understand what's happening here, it can just seem like a bunch of fuzzy lines with a lot of little dots. And while that's true, breaking it down fundamentally, this becomes very clear, because what you end up seeing is when you reach these peak moves, either very close to the zero line or positive, you've pretty much reached a situation where the market is overbought. And right here you can see that we reach these points, and we also get our additional self-fractal setups. It's telling us, okay, time to sell those setups and wait for the next long setup to occur. And when we dip below the red line right here, it lets us know that we've had an extreme amount of sellers, and all we look for is the first pop back above those, and that usually gives us very strong buy signals at the bottom. Further, though, we can utilize dips below this red line because they tend to retrace about 86% of the time to that same low. And these added percentages really give us a clue when we're looking at whether it's intraday or whether it's daily or even from a weekly, as to which low areas the market players are really interested in when it comes to a retrace. For instance, when we have these positive extremes, under certain situations we know when they're going to retrace. This one was not likely to be a retrace setup at the beginning of it because we had rising shakeout. But once we reached overbought and we got to positive extremes with lower price setups, like right here, we knew that that was the end of this particular run, and we're able to take advantage of that. Likewise, we had a similar situation right here, and again right there. And it made it very easy for us to call the peaks in the market. Now, it also lets us know that when we have these positive extremes, like back here, that a likely retrace point for the SPY is going to be down at this 141 level. Will it happen specifically on this particular move? Well, we have our targeted setups. We know that we're likely to retest this setup here that dipped below and hasn't been retraced yet. And then the next level will be this particular one here. And so when people draw support and resistance lines on charts, it's a little bit of a chuckle, because if they don't correspond to what we see as the actual fractal players, then people are confused as to why that support over here held, this one didn't hold, another one was broken with ease, and it becomes confusing as to what overbought and oversold is. And this extreme histogram really clarifies that, and when you begin to learn the nuances of it, and we go into detail with it, it becomes striking clarity as to where the market's about to go. And so when you combine all of them together and are able to use the synergies that they each provide one another, it becomes very effective trading for the market. And so this 10-minute video really gives you the broadest spectrum of the indicators that we use. Now, there are more of them, and each of them I go into detail both in the YouTube videos and in other links for tutorials on our website. And those are all made available free so that you can learn and understand some of the concepts behind these. And can be very effective if you're willing to take the time. So hopefully you'll utilize the resource of these indicators and get an opportunity to understand a little bit more about some of the intricacies that exist within the market and aren't just as visible as some of the basic indicators try to indicate that they are. As always, though, trade well.